Okay, so in this video clip, we're going to take a look at forward and future contracts, and they might be considered as basic building blocks for other financial instruments. Normally, when we look at these, we consider the payoffs and the payoffs under different circumstances. So for instance, if we were to look at a long forward or futures payoff, normally we're considering what happens in the event of the price going up or down of some underlying. So we might take the price of the underlying, or we might also take the futures price. And remember that the futures price and the spot price, they tend to converge. So over time, the two get quite close and then converge ultimately at the end over a certain time period. So if we're considering the current time period and looking to the future, to some maturity date, then the two converge. But we're interested in looking at what happens when we have a long position and the futures price goes up. Does this save us money, or do we lose money? And again, let's consider what the long position means. The long position means you're buying. You're taking a position where you want to acquire some asset. Could be oil, could be wheat, could be pork bellies. These are the traditional commodities that trade on many exchanges, orange juice futures, and then there's an array of future contracts on currency and on financials like bonds. So for instance, the futures market can be even bigger than the underlying. The futures market for bonds, bond futures market exceeds the size of the underlying bond market, even though the same underlying is implicit in all the trades. But if we were to, before we start providing representations of the payoff, we might consider the a little bit some definitions, perhaps. So the futures market is distinct from the forward market. And the futures market is exchange traded. Okay, so typically when we're thinking about a futures market, maybe the CBOT or the CME, Chicago Board of Trade, or the CME, the Chicago Mercantile Exchange, both of these now have come together and have merged into the CME group. But you have, in Europe, for instance, you have Euronext Life, and you would have Dow Terminbors, Sofx, and in Singapore, and in every well-developed market, you tend to have future markets. The futures contracts are exchange traded, right? So we should think of the futures contract as something, as a good that trades on an exchange. And critical here is it tends to have very standardized contracts. And so things like delivery are specified in the contract, and you have standardized dates and you have a standardized quality. So when we talk in terms of bushels of wheat, we specify very clearly what the minimum, we set a minimum standard for delivery, to satisfy delivery. And if we don't meet that minimum standard, then we can reject the good that's being delivered from the person with the selling or the short position. In contrast, the forward contracts tend to be traded in OTC markets, over the counter. And these tend to be then broker to broker. Or it could be somebody in one bank phoning somebody else in another bank, and they agree dates and so on, delivery, what's to be traded, prices. So you know in advance what the price is, and the quantity and quality. Okay, now In the case of the forward contracts, they're not either not standardized or they're less standardized. Okay, so there's a lot more scope here for doing something a bit different, for delivering a slightly different type of wheat or considering a different type of lumber that's not necessarily consistent or maps into contracts to trade on an organized exchange. In an exchange traded futures contract, typically you post margin, and that's a way of safeguarding the counterparties against credit risk. It protects the exchange and it protects the counterparties, that one of the two counterparties who intermediate through the exchange might default on a position. In the case of a forward contract, there may be some operation of a margin account, but tends to be less formal. And maybe it doesn't exist at all. There may not be any formal market to market in a forward position, right? You probably depend more on reputation, and probably you, from time to time, you must make recourse to system of courts or the legal system. So if somebody doesn't satisfy their end, if a broker decides to default on a position, then perhaps you try to get some kind of legal remedy. In the case of an exchange traded futures contract, no need for legal remedies. Typically, if you can't pay what you owe, then your position is closed out, and whatever money you subscribed to your margin account, that's taken to cover whatever losses that might occur. So typically speaking, exchanges are well organized. They have a secretariat that accounts for gains or losses on the position over time. And if you're losing money and cannot subscribe additional, if you cannot satisfy additional margin calls, your position gets closed out. So the person on the other side of the contract is protected and the exchange is protected. Again, one way of trying to understand some of the dynamics here is to consider the payoff. And that's what we're going to focus on. So let's go back to the long position for a moment. Long just means buy. And in many instances, we have to buy something. We might have to buy oil, or we have to buy wheat. If you're a breakfast cereal producer, you need some underlying material to go into that cereal. If you're a utility and produce electricity, typically you generate electricity through using oil, or maybe solar. But many industries are highly dependent on petroleum and jet fuel. And to hedge your position, airlines sometimes will use forward or future contracts in order to take on a long position. So for instance, how could we use a futures position to protect us against a rise in the price of oil? Again, we've got to think of a timeline. We could think of the current time period and then some date in the future, the maturity. And if we thought today was July 2020, then in 1 year's time, we're looking at a maturity of 2021. And the contracts would mature at this point. Then if we are a utility or an airline and we have an exposure to oil prices through either jet fuel or through the cost of just generating electricity, then one way we could hedge this position is we take the long futures position. And let's imagine for a moment that the price of oil is currently, the current futures price for 1 year maturity is $100. Then we could open a long futures position or forward position where we agree to pay $100 for 1 barrel of oil in 1 year's time. And if it turns out, again, we don't know the future, nobody really has a crystal ball, but if we think of time and then we think of the price of the underlying, again, it could be, we think of it in terms of the futures or the spot, and remember the two will converge. that can go up or down over time. But if it goes up, then that would mean all else being equal, in July 2020, you would have to pay that extra price. So if we're starting from a baseline of 100, as the price goes up, that imposes costs on a business, may throw the business into being non-profitable. If the price goes down, very good, your costs are reduced, you make more profit. But many businesses, their main problem is just managing the uncertainty. It's to deal with the risk. You want to protect yourself against the risk of the price shooting up. How do we do this? One approach would be we agree today. So we look at the current time period, July 2020, and we say, okay, how do we protect ourselves against a rise in the price of some underlying commodity that we're heavily reliant on? And the way we do this is we take a long futures position. So what happens? In the case of a long futures position, on the vertical axis here, we have the payoff from the position. On the horizontal axis, we have either the futures price or the spot. We're going to say spot, the futures. If the price goes up, if we agree to buy today at 100 with delivery in 1 year's time, and the price, let's say, turns out to go up in July 2021 to 120, then the futures contract saves us 20. The payoff here is, if you like, the payoff was represented this way. The profit from a long futures position is equal to F negative K, where K is the delivery price, and that was set in the original contract. Okay, so we take this K, as perhaps you can think of a constant, K as being representing a constant, and we lock in a price, 100, on the exchange for the purchase of oil at that $100. And then if the price goes up, we save some amount of money. But if the price goes down over the same period, rather than going up, then we lose 10. Okay, so in many respects, this is a zero-sum game. But the benefit of having a long futures position is we get certainty about the future. And because there's a margin account operating typically on an exchange, because of the margin account, then we're not fearful of credit risk. Okay, we lock in, we purchase, we agree today, July 2020, to purchase oil in 2021, 1 barrel of oil at $100. We call that K. If the price goes to 150 at the maturity date, then the gain on the position is 50. Why? Because we can buy at 100 for something in July 2021 that has gone up to 150. That's a saving of 50. If the price slumped in that intervening period over the same period, instead of the price going up, the price went down, let's say to 80, then we save 20. Or we lose 20 in the position. Okay, so we would say we lose 20. Okay, now that's obviously the gains here are offset by the losses over a long period of time. But what we find is that during this period, we have certainty. And that certainty is very valuable, right? It's like insurance. We take out health insurance, we take out car insurance, we take out life insurance. We have all these insurance products that are heavily traded, heavily used, heavily depended upon. Most of the time, we don't see these as providing opportunities to make profit. What they offer is certainty. And the futures market may be a way for us to gain certainty. If there's somebody also, it's worth noting, somebody is buying, somebody with a long position must be an offsetting short, somebody's selling. Okay, so we talk about a short position, which is a sell position. And if one counterparty gains on the back of the price going up to the tune of 50, the other counterparty is losing an equivalent amount. They have agreed to sell at 100, right? Consistent with the person who is buying for 100. The price goes up to 150, you have the short position, then you're losing 50. So we can see, when we look at this, we have a zero-sum game, okay? Okay, let's leave that there.